the recently released RBI report on trends and progress of banking in India 2024-25. So today's session is critical because it decodes the roadmap to 2030. We are transitioning from a phase of balance sheet repair to a high growth digital first era, understanding the nuances of the expected credit loss network, the rising tech risk paradox, and the RBI's vision for sustainable finance is essential for every executive in this session. Shri M.S. Sundararajan, former chairman and managing director of Indian Bank. And before I hand over to Sundararajan sir, a quick note. Now I invite Sundararajan sir to take us through the strategic landscape of Indian banking.
Yeah, it's a pleasure to talk about the topic of trends and progress in banking. As you know, year after year, RBI comes out. RBI comes out with a. See, it is always a pleasure to talk on this topic of the trend and progress of banks in India. RBI, as you know, toward the December end, has provided this raw material. Friends who are in surveys say always the trend and progress begins with global growth, domestic growth, and then to 3.2% in 2025, 3.1% in 2026, and it was 3.3% in 2024. Figures are easy to remember. Remains below the pre-pandemic historical level of 3.7%. So 3.7 has become the base. When they want to compare, they will compare. Is it above or below? So we continue to be below. And then what are the risks? The risks to the outlook remain and uncertainty. There is a trade policy, there is an uncertainty. If you ask what is the growth, what is the expected growth rate of the advanced economies, it is only 1.6%. Supported by how it is happening, there is a fall in the softer energy prices and also there is a subdued demand. See, the various economies have resorted to the monetary easing policies. US Fed cut, it is in the range of 3.5 to 3.75. Bank of Japan is about 1.5, ECB at 2%. Now, how the global banks are weathering the storm? Global banking system has demonstrated their resilience. Again, strong capital and liquidity buffers have been built since 2008. The threat is there is a credit risk is emerging. The strategic priority for the global bank, risk management. The debt market also, if you see, it is continuing to shift toward the government sector. So the exposure of the banks and non-banks remaining elevated, stress in, as we move to the next digital transformation, banks have to globally invest heavily in digital transformation and artificial intelligence to enhance the operational efficiency and customer experience. Climate integration. Integrating climate-related the financing into the core risk management is the need of the hour for the long-term sustainability. Comes out as a part of the annexure charts, etc. The capital adequacy ratios across the major economy, China, US, India, Mexico, UK, Netherlands, Indonesia, etc., and regulatory emphasis on building resilience buffers. That way, it indicates. Now, as we move further, the profitability, return on assets, if you see globally, emerging markets demonstrated superior profitability, are leading among the emerging market developing economies. Bank equity prices fell sharply, but recovered post 90 days pause, and then CDS spreads narrowed, reflecting improved market sentiment and lower perspective of default risk, below 2%. Provision coverage ratios remain above 100% for Chinese bank, while it is more than 50% for the banks and advanced economies. Why? because of the trade tensions, because of the geo-economic fragmentation. And then the growth moderating and inflation falling, most central banks continue with the monetary policy easing. Since 2024, the banks have started coming out with the monetary policy with the easing cycle. So although the credit growth moderated in 2024, apart from what is the recommendation? Apart from prudent regulation and supervision, see, when you compare that and India, India has become a beacon of stability and growth in a turbulent world. To summarize, what is this? In one word, a beacon of stability and growth in a turbulent world. Showcases a rare combination. Please remember, a rare combination of high growth, moderating inflation, stable policy landscape, creating a fertile ground for the banking sector's GDP. Real GDP growth is 7.3%. CPI inflation is around 2%. What is that driving? Broad-based demand, and S&P, Standard & Poor's, have also upgraded India's outlook in August 25. Talking about the Indian bank, India's banks balance sheet dynamics, you can see SCB, Scheduled Commercial Banks balance sheet expanded by 11.2% in 24-25. I am taking poll to Newcastle. I am aware of this, but yet you please remember again and again talking about it. You will be able to remember even in sleep. Again, what is the banking sector performance? GNPA is about 2.31%, down from 2.7% in financial year 24. Again, talking about the public sector banks. Public sector banks roar back to profitability of 1.78 lakh crores. They have, as we move further, public sector bank credit growth is about 12.2% in financial 25, 13% in half year one of the 25-26. Market share 58% of the advances. Gross NPAs of the public sector banks is about 2.58%, but the scheduled commercial bank is about 2.31%. It is a bit higher. Private sector bank credit growth is 15% in financial year 25, 10% in half year of the 25-26. GNPA is about 1.8%. Again, asset quality already we have seen. Provisional coverage ratio we've seen. I'm sorry for the duplication. Capital adequacy is about 17.36%. Liquidity coverage at a healthy level of 143%. Growth firepower, fortress balance sheet, it provides necessary ammunition to aggressive thing. India's next growth phase is on the infrastructure projects. Again, RBI has also come out with the changes that also we will see in detail in this thing. RBI preemptive strike on unsecured credit. This only action replay of what are the steps that are taken by RBI in 25-26. That way, in the RBI, we should compliment RBI. They undertook a calibrated approach in the conduct of the monetary policy to support economic growth and easing inflation pressures and open space for the policy accommodation. Okay. And then the risk weight increase, unsecured loans rise to 125% for banks and NBFCs. Credit card receivables, 150% for banks, 125% for NBFCs. Unsecured personal loans have come down because of the regulatory thing to 11% year on year. Credit card borrowing has come down 18%, and the RBI has reversed the increased weightage on bank loan to NBFCs in April 25. I'm having only recapitulation. Again, the first section, it comes out with all the important directives of RBI in 24-25. Like, for example, they came out with the credit information reporting, transaction account direction, non-banking financial companies, review of qualifying asset criteria, for non-banking companies, microfinance institution, and then technological innovation, consumer protection measures, institutions safeguard against voice and SMS financial frauds. You will get it. Now, as we come to this industry and services, they are fueling the economies. Industrial credit rebounds. Credit industries accelerated 9.6% year-on-year growth up to November 25. Again, retail and agriculture, there is a stress. Personal loan, there is a robust growth of 12.8%, underpinning the consumptions. And then housing loans and credit card outstanding have shown moderation. Digital payment, India accounts for 46% of the global digital payment volume. So it became the leader and the prime target for sophisticated with leadership come responsibilities. And fraudsters or UPI phenomenon, transaction volume surged 35% year on year. Average ticket size declined to 1,348. What it means? It means deepening of the penetration with regard to the micro transaction, credit on UPI, integration of credit lines with UPI network set to challenge the traditional credit cards. So what is happening is they are not able to bear this MDR cost. They are trying to have a negotiation with the government to see how we can bring about the changes in the based on the scale, so that this industry cost can be brought down. About the digital payment, there is a revolution that is taking place. And then banking law amendment 2025 Act enhances the depositor security, strengthens governance, create faster stress resolution framework, and also there is a green banking, RBI pushing climate risk interrelated financing principles and sustainable solutions as national imperative. That is another thing. They have different model. Plug and play model, it eliminates the complex one-to-one integration between lenders and data providers, enabling lenders to connect once and access comprehensive data arrays for efficient credit assessment. Now, more than 136 data services supporting different loan journeys, including authentication, land records from 8 states, satellite services, property search, and credit guarantee. All these things are things, and ethical consideration. That is why they have come out with the FREE, Free AI Committee, framework for responsible and ethical enablement of AI, constituted in December 24 and submitted the report in August 25. So, business correspondent model, Kisan Credit Card Scheme, lead bank schemes are under comprehensive reviews to enhance the effectiveness. And then the financial inclusion index is one of the things to measure. It improved to 67% in March 25. Delivery of equitable, responsible, suitable, and affordable financial services supported by livelihood enablers, by consumer protection enhancement, climate finance integration, supporting the economic growth, and also as inflationary pressures have eased after maintaining the policy repo rate at 6.5% through Q3 24-25, the MPC reduced it cumulatively by 125 basis points to be at 5.25% in December 25. Organized across 11 types of regulated entities, including commercial bank, urban cooperative banks, and non-banking finance companies. So the consolidation significantly improves the accessibility of the regulatory instructions, high growth, record profitability, robust capitalization, and vastly improved this one. What is the important thing? They should navigate the expected credit loss guidelines, invest in cyber securities, address the agricultural NPA issues. The policy framework, the trends and progress also talk about the thing, how to strengthen the financial market infrastructure. It talks about the municipal bond repo framework, the introduction of repo transaction and municipal bonds, the framework improves the liquidity of the municipal securities while expanding the suite of the instruments available for repo and reverse repo markets, creating a deeper capital market for urban infrastructure financing. And then there is also electronic trading platform. Master directions issued on 16 June 25 replaced the 2018 framework, facilitating the transaction in securities, money market instruments, foreign exchange, and derivatives. Brokers now can access NDSO, that is negotiated dealing system, order matching for secondary market transaction in government securities. Thereby, it broadens the market participation and enhancing the price discovery mechanism. And then there is also a forward contracts in G securities. Introduction of the forward contracts enables long-term investors such as insurance funds to manage the interest rate risk across the cycles while facilitating the efficient pricing of the bond derivative and the concentration restrictions for foreign portfolio investors in corporate debt securities under the general route provides a greater investment ease and promotes foreign capital flows to Indian corporate under the FPI investment relaxation. And then it also, there is a strategic extension of the market trading hours, enhances the price discovery, optimizes the liquidity requirements, and facilitates the market development across the money market segment. There are also a lot of enhancing credit delivery and financial inclusion. Agricultural lending reform have been issued. Collateral-free agricultural loan limits have been increased from 1.6 lakh crore, 1.6 lakh to 2 lakh. Then priority sector lending framework, there is a revision of the revised priority sector guidelines effective from 1st April 25, enhance the loan limits across the multiple categories, and then broaden and then rigorous authorization process, minimum capital requirements, governance standards, and fit and proper test ensures credible entities to operate, strict KYC, AML checks, and regulated escrow operation protect the consumer trust. Mandated from 1st January 26 require acquiring banks to conduct full KYC of AEPS touchpoint operators with periodic update and re-verification after 3 months inactivity, continuous transaction monitoring, operational parameters, reviews, and strengthen fraud risk management, enhance the security and prevent the misuse. And then instances of penalty imposition increase across most regulated thing except public sector bank, payment banks, and credit information companies. However, total penalty amount declined compared to 23-24. That is the thing. And what are the violations? And then asset classification, violation of income recognition, asset classification norms. There is a thing. And then there is a reporting requirement, failures in CRILC platform, reporting and credit information submission. The banking sectors demonstrate the strong fundamental with improved asset quality and robust capital buffers, positioning it well to support the sustainable credit expansion whilst managing the emerging risk. Again, housing finance company sector, primarily conduit for housing credit, intrinsically linked to the thing, and affordability trends. Cooperative banks, crucial for last mile credit delivery and financial inclusion, but exhibit significant stress in rural segment. And then it talks about the alternative investment funds things and also primary dealers, the wholesale financing backbone. So All India Financial Institution and primary dealers, it talks about the NABARD, SIDBI, NHB, Exim Bank makers for government debt, ensuring smooth borrowing program, execution, and monetary policy transmission. They significantly improved the profitability, trading rains from declining bond yields. Their critical role as India's debt market deepens. So regulatory overall, again, it is only an action replay of what we have done. expected credit moving from incurred loss to expected credit loss, model for loan provisioning, forces forward-looking capital allocation for anticipated future stress, stricter board appointment norms, zero tolerance approach to poor governance following Satyam and PwC cases verdict, organization and simplification, consolidating the master circulars, etc., which we have already seen.
And this section will be taken by Sundararajan sir, Kalia sir, and Dr. Fareed Ahmed. And in this session, we will also cover the economic survey, which will be announced a day before the budget is announced, which is FinTech Innovations in Retail Banking, a Practical Implementation Guide. And this session will be taken by Shri Sunil Soni, a former Chief General Manager of Punjab National Bank, who is presently a member of the MEITY.
Banking the position, I am reminded of 2008, and at the cost of repetition, I always say that that euphoria of resilience should not be there. Proper risk management practices should be followed for the orderly growth, so that what occurred between 11 to 18 in competition with the public sector bank. You must be knowing 3 of the RRBs are also going public. They've been asked to go public for the IPO. So, I mean, these are the sectors that our bankers will be watchful about it.
Go in for some kind of deep dive and understand its implication for our better understanding and for taking proper, approach in our day-to-day strategies or, whatever role we are performing.
But being a banker, our salary is getting deducted by tax. So we are taxpayers, we pinch us. So what RBI is taking steps, and that should be the awareness among the citizens, being Indian citizens, that what RBI steps is taking to reduce the current account deficits.
Then the deputy governor has gone on record to clarify, no, we are not interfering deliberately. So each and every economy has to protect itself. What is required at optimum level, RBI is also doing. So if you see, whatever that optimum level, because RBI is also consciously aware that no, they are living in a glass houses and everybody will be watching. So what they are doing is a thing. Current account deficit is another thing. This is arising out of exports and imports. See, there also the current account deficit in the range of about 1.2%. That is because of what is going to be happen, the measures introduced by US by way of whatever that duties and other thing they are imposing and they are going. In fact, I should compliment all the people who are working in my remarks. This is what is happening. So whatever that RBI intervenes with regard to exchange rate is a optimum that they are required to do, or else the rupee will go for toss. I will leave it to Kalia Saab and others to interact. Yeah.
Second reason, whatever rupee dollar swap that they do, that is for the purpose of meeting the liquidity requirements because their one requirement is also that there should be always liquidity available in the banking system. And whenever there is this kind of movement that takes place, because ultimately all exports and imports, now there is an internalization of Indian rupee that will take some care. Otherwise, you will see all is denominated in foreign currency only. Very significantly, thanks to whatever policy measures are being taken. And whenever there has been that kind of issue, I think Reserve Bank of India is coming out with appropriate measures to take care of that. That you would have seen recently, like Punjab National Bank, I remember, have come out. So banks are undertaking that kind of exercise. What would be the impact? I personally believe that given the kind of resilience which we are experiencing as of now, there will not be any dramatic impact. And in order to shield the banks from any kind of adverse impact, they have given a glide path of 5 years, starting from 27 and ending to 31. So in that particular context, if that glide path has been given and that is to be implemented over a period of 5 years, I do not see, though I don't have any statistical data to share with you how much impact is going to be there, excepting for 1-2 banks which have come out with their estimates.
First of all, thank you very much, sir. Nice. I think one small compliment. The presentation which you shown today is much more crisp than the last presentations on because I'm a member and it's very simple and very straightforward. That is one compliment. Really good to see that. And that way, do you see is inflation going to increase and there are repercussions because of that on the overall economical sectors and the other sectors which will uh, be definitely getting impacted because of this. So I would like to hear from both of you, sir. Thank you very much.
We never knew that US is going to do this act of going and taking and then telling them and then taking a Nobel Prize from that deputy chief, that thing, etc. I mean, it's all looking like a politician model of doing things. And to see that nothing turbulent is happening. And India's relationship with China is also improving. It is a good thing that we should thank Mr. Trump that we are tending to become friendly with China, though there is issue-wise differences that are happening that will always be there. What one good thing with India is issue-wise differences, we don't make it as a personality-wise differences. We should complement India's approach. The the external affairs minister and the prime minister, we should complement them. We generally criticize, we should complement where it deserved. That way, in the periodical monetary policy report, they are not viewing it as a threat. But at the same time, we are prepared to meet any challenge. That is my simple reply to your question. What do you call yourself?
And in that context, I mean, you would have seen the kind of policy measures that are being taken in order to promote wind energy, solar energy. All alternative sources of energies are being, explored. How did we try to deal with that? So I think some kind of policy interventions would take place at appropriate level in order to ensure that we continue to have energy security available for our country, while we will continue to promote alternative sources of energy also.